Good morning. Welcome back to the Retirement Report. I'm Hank Parrott, your host. All right, we're getting into inflation a little bit before the break, and I'm going to delve into that a little more because one of the things I want you to understand about inflation is it's not just, when we think of inflation, we think of investing, right? We think, okay, if I need to take 4% out of my money that I've invested, all right, that I'm going to need 4% as a drawdown to supplement my income. Now I've got inflation, so I need to make up for that 3% on inflation, and then I got taxes, and maybe I need 1 or 2% on that. So I might need to be making 7 or 8% if that's my drawdown rate. Now this can vary according to your individual situation, but this is important in understanding how much your money needs to make. And in particular, let's throw in another piece to that, and that's this thing about Social Security benefits, the reduction in the purchasing power. So because the COLAs on Social Security, the cost of living adjustments that Social Security Administration applies each year, okay, or most years. In that situation, what we're looking at since the year 2000, over the last 17 years, we've seen that Social Security purchasing power has been reduced by about 34%. So over a third. That means your money that in 2000 compared to today, I can only buy 2/3 of the thing today that I could have bought with the same money in 2000. All right, think about that. That's pretty significant. And how do I make that up? So on my investments, it's not just my investments need to keep up there. I may need to be thinking of how can my investments help make up the difference in what's going on with Social Security. And by the way, when I do with my clients, when I'm working with clients and when they're coming in first time, one of the things we do is we use an inflation rate of 3%, but we use cost of living adjustments based on historical numbers from Social Security of only 2%. So it is more realistic, all right, of what goes on with regard to your actual purchasing power of those Social Security benefits. So we're seeing that when we're running the numbers and showing you your financial future. That's a part of how we do that and making sure that we're accounting for that iniquity, if you will, to make sure you're still going to be able to then attain it. So when I show you your financial future, what I'm looking at is when we're running our numbers for our clients and we're saying, okay, here's what your expenses are, here's what your what it costs to maintain your current standard of living. Maybe we have some fund money thrown in there. Here's what you have for taxes. Here's what your future income sources are going to be, some Social Security, pensions, whatever it might be. Here's what that, if you have any special expenses still that need to be accounted for planning purposes, maybe some gifting or some college education for grandkids or whatever it might be, we factor that in, of course, and then we can see how much money you're going to need from your retirement accounts, all right, to be able to maintain that standard of living or improve upon it, right, with some additional fund money. We want to have fun in retirement, right? Retire with style. This is about thriving, not just surviving. We want to enjoy those years. So we take that into our planning in that consideration. All right, I'm going to delve into, what's that? Caller, we have Kendrick. We're going to go to Kendrick. Welcome to the Retirement Report.
How you doing?
Very good, sir. How can I help this morning?
Yes.
You need to turn down your TV because there's a time lag there. It's going to throw you off. It's going to be hard to talk to me.
All right. I want to. I'm going to Social Security, and I wanted to know. My money is. You was talking about where it's not growing.
Right. Cost of living and your cost of living adjustments from Social Security are less than what the purchasing or less than what your expenses are going to go up at. Yes. So you have a question, Kendrick?
Yes. So if you got let's say you got a bank account and it's not growing enough interest.
Right.
What would be best to invest it in?
Okay. Excellent. All right, good question. So one of the things that it comes in, first off, is this has to do with having an emergency fund. So in fact, what I'm going to do in it, I'm going to finish this little bit about talking about the inflation, and then pay attention on the next part because I'm going to lay out for you some investment strategies, okay?
Okay.
All right, but hold on just a second. We're coming right into that. All right, one of the things that in going back to the inflation piece and then showing how you structure your finances to accommodate that. So when it comes to inflation, what we're looking at is in fact, they're even proposing a new consumer price index. So we have consumer price index, the regular consumer price index that they factor in. They have a CPIU urban, they call it, and now even what they're talking about developing is a consumer price index for the elderly, or so what kind of expenses when you reach I hate that word, right? When you reach retirement, what kind of expenses do you have? Does your spending habits or the things you spend money on, are they different? And this is where that comes in. So things that we typically spend money on when we reach retirement age would be more, maybe, medical may come in more. Of course, energy, as far as gas for our cars and things like that. Travel and entertainment and things like that come into play. Housing costs typically become more steady, and so we're not concerned about rising costs on housing. We're more concerned about rising costs in other areas that we're going to spend money. And it's understanding that difference, because that's what we want to pay attention to when it's as far as an inflation rate goes. All right, when it comes to inflation, then understanding that, again, going back to that, think about that again for a second. It's not just that we need our money to grow to stay ahead of inflation, but we may need a little extra in there because, we just talked about Social Security benefits aren't going to keep up, so we may be able to, we need to make enough to make up for that as well. All right, we're going to go to a slide here called the three worlds of investing. And when it comes to investing, and this is what I was just talking about with Kendrick, when it comes to investing, some things that we want to consider. Well, first off, you make sure that you've got an emergency fund. Some basics of financial planning are going to be that I've got enough in my checking account for at least 1 to 3 months worth of my living expenses. 2 is I'm going to have an emergency fund with about at least 6 months worth of my expenses there that I want. So if I spend $5,000 a month, I want to have $30,000 in a emergency fund. If I spend $10,000 a month, then I want to have $60,000 in an emergency fund. So the math works no matter the number. Then the next piece is I may have a short-term fund. So a short-term fund is where in the next, say, 3 to 5 years, I may have some big expenses. Maybe I'm going to buy a car. Maybe I'm going to do some major thing around the house, renovations or what have you. Maybe it's going to be some, special trips over and above my normal vacationing. Whatever it might be, add all that together, that's my short-term fund. I do not want to invest that with a long-term strategy, right, where the market fluctuations or other things could impact that. For instance, if I'm going to spend money in 3 years, I don't want to take out a 5-year CD, even though I would like that higher interest rate that it's going to pay me, or a 5-year fixed annuity for that matter. Even though I would like to get that extra 1% a year, at the same time, if I'm going to spend that money in the next 3 or 4 years, then that wouldn't be a good idea. So I need to always match up my time horizons with those monies. So my short-term fund, I'm going to keep in a short-term type of investment. Then I have my long-term money, my long-term investment money, and that's where I can go into more long-term strategies. And those are going to be typically my retirement accounts, money that I'm going to need for income, and we have different strategies we employ there as well. So again, when we're looking at the first world there on your left on your screen, that's of protection and safety. That's where that short-term money and that emergency fund and our operating account, all of those kind of fit in there. That's things like savings and checking and money markets and CDs. Savings bonds may fall into that. Those tend to typically be a little more long-term, but they're safe. Treasuries are another part. So this world, I might have some monies in on the short-term stuff. I typically don't want to go long-term on those because, again, of what we're looking at, even on the long-term side, as an example, savings bonds, or if we look at treasuries are still paying less than 3% a year. So why would I can't, and that's a 10-year note. So I don't want to get into that. Or fixed annuities where I don't want to take out a 10-year or a 7-year maybe even, but they're not paying enough to stay ahead of inflation and taxes even with those longer terms. So those I typically use only for short-term type needs. And what do I like about them? Of course, principal is guaranteed, interest is guaranteed. There are penalties for early withdrawal, so again, we want to tie them together, especially when we're talking about CDs and fixed annuities. We want to make sure the terms match up with our goals. All right, inflation and taxes. If inflation and taxes are running 3 to 5 and they're only making 1 to 3, that's not going to be a good fit long term, right? So we have to stay ahead of inflation and taxes. How do we do that? Well, we look at things, maybe we go into the stock market. This has been one of the things that people have done for many decades, of course. So there we'd have individual stocks, individual bonds, or maybe we have mutual funds, which are, you know, basically a basket of a lot of stocks or a lot of bonds, or maybe a combination even of those. We have things that are called exchange traded funds. These are like mutual funds, many of which now indexing. This is a really important thing, concept to understand. We'll talk more about. When we get into REITs, real estate investment trusts, this is an area that I would avoid. REITs are one of the few investments out there that I can put money in. Let's say I invest in a stock or a bond and it doesn't do well, or a mutual fund, and it's not doing all that well, and I decide, you know, I want to get rid of that and do something else. Well, I can get my money out. I might take a loss, whatever, depending on when I sell it, but I can get my principal back, or the amount that's left in there I can get out at any time. REITs, unfortunately, can, you know, there I can get locked in. If they get into problems, and they typically run on a short cash flow, and that's very possible, then I cannot get my money out. My money can get locked up to where even I can't take it even at a loss. I can't get my money out. So I don't like REITs, so we avoid those. And last is variable annuities, and those you want to avoid as well. And I'm going to talk a little bit more of those. We're going to take a quick break. When we come back, I'm going to talk about variable annuities and how they fit or how they don't fit. When we talk about annuities in general, there's a lot of stuff in the news, and I've heard, you know, you'll have to, depending on your personal experience there, but if you're reading things and it's usually negative about annuities, it's typically regarding variable annuities, and I'll explain about that when we return. So when we come back, a little more about, we'll do a little quick tutorial on annuities and how they can possibly play in, and how investing in general, how to make more money on your money, right? How to make sure you can stay ahead of inflation and taxes and attain and maintain your standard of living, quality of life, no matter how long you live. That's what it's about, right? Join us here. We'll be right back on the Retirement Report. When could paying more tax mean paying less tax? Here is money tip number 54. With tax rate at historic lows, consider